So you have a $1,600 RAM payment and you're $30,000 upside down. That means even if you sell the truck today, you still owe enough money to buy another problem. This is how people get trapped in car loans. They don't buy a truck, they buy a payment. And once that payment gets too big, every option starts looking painful. So let me break this down. If you have a $1,300 truck payment and then your insurance is another $300, you're not paying for transportation anymore. You're paying rent for a vehicle that loses value every month. At that price, the RAM should come with a bedroom, a kitchen, and a realtor explaining depreciation. Now here's where it gets worse. Let's say you owe $68,000 on the truck, but the truck is only worth around $38,000. That means you are around $30,000 upside down. And this is the part most people don't understand. Being upside down does not mean the dealership is going to magically erase that money. That $30,000 has to go somewhere. Either you pay it, or you roll it into another vehicle, or you keep driving the truck until the loan balance comes down. Those are usually the real options. And this is where people make the second mistake. They say, I don't have money down, but I can afford the payment. No, if you have no savings, no margin, and the only reason you can afford it is because the payment clears every month, that is not affordability. That is survival with leather seats. Now, if your credit score is strong, you may have more options. You can look into refinancing. You can see if a credit union gives you a better rate. You can check if your current loan has a high interest rate. But if you are already at a decent rate, refinancing may not save you much. And if your credit is bad, refinancing becomes even harder. Because lenders don't just look at the truck. They look at you. They look at your credit report. They look at your payment history. They look at your collections. They look at your charge-offs. They look at your repos. They look at your hard inquiries. They look at your debt to income ratio. And if your report is already damaged, the bank is not thinking, let's help him escape. The bank is thinking, how do we protect ourselves? Now here is the first real step. Before you try to trade the vehicle, before you apply for another loan, before you walk into a dealership asking them to make it happen, fix the credit file first. If you have collections reporting on your credit, work on removing them if they are inaccurate, outdated, duplicated, or unverifiable. If you have charge-offs sitting there, review them and dispute anything that is reporting wrong. If you have late payments, check the dates, the balances, and the reporting history. If something is incorrect, challenge it. If you have hard inquiries you did not authorize, get those removed. Because every negative item makes the lender see you as more risk. And more risk means higher interest. Higher interest means higher payment. Higher payment means you get buried faster. That is how one bad car loan turns into a credit problem, and then that credit problem turns into the next bad car loan. Now here's the part that surprises most people. Sometimes the best way to get out of a bad car loan is not another car loan. Sometimes the best move is to stop shopping. Pull all 3 credit reports. Experian, TransUnion, Equifax. See what is actually hurting you. Then build the strategy. Because if your credit is bad and you keep applying for cars, you are not fixing the problem. You are creating more hard inquiries. You are making the file look desperate. And then when you finally do get approved, it's not a real approval. It's what I call a painful approval. That means the bank says yes, but only if you bring $10,000 down, or $15,000 down, or accept a crazy payment. That is not the bank saying congratulations. That is the bank saying, please make this risk worth it for us. Now let's talk about the lease option. A lot of people use lease incentives to escape negative equity. For example, if a vehicle has big rebates or incentives, sometimes those incentives can absorb part of the negative equity. So if you are $30,000 upside down and you have $10,000 down, maybe the dealer can roll part of the remaining balance into a lease. Then you drive the leased vehicle for 2 or 3 years, return it at the end, and the old negative equity is gone. But listen carefully. This is not magic. You are still paying for the mistake. The only difference is now it is hidden inside a new contract. So yes, a lease can sometimes help, but you have to check the mileage limits. You have to check the payment. You have to check the fees. You have to check if there is a penalty for going over miles. And you have to make sure you are not just turning one bad decision into a cleaner looking bad decision. Because if you drive a lot for work, a lease may become expensive later. And if your credit is bad, you may not even qualify for the best lease incentives. That is why credit repair comes before the dealership, not after. Now let's say you are $12,000 upside down. That sounds better than $30,000 upside down. But it can still trap you. Because if your truck is worth $30,000 and you owe $42,000, that $12,000 does not disappear. And if you only have $500 down, but you want to move into a newer, more expensive truck, now you are stacking debt on top of debt. This is how people go from one bad payment to an even worse payment. They don't want to downgrade. They don't want to wait. They don't want to fix the credit first. They just want the next vehicle to make the last mistake feel better. But the next vehicle does not fix the last mistake. It just gives the mistake new tires. Now, if your credit is already damaged and you have a bankruptcy, a repossession, collections, charge-offs, late payments, and no money down, the answer is not another expensive vehicle. The answer is repair the file. Because when a lender sees bankruptcy and repo, they don't care how bad you want the truck. They care how likely they are to get paid. And if your report shows that the last lender did not get paid, the new lender is going to make you pay for that risk. That means higher down payment, higher interest, shorter terms, or a denial. And sometimes they will give you what looks like an approval, but it is really a soft rejection. They say, yes, you're approved, but then they ask for $15,000 down on a $19,000 vehicle. That is not an approval. That is a polite way of saying no. So here is the real process. Step 1. Stop applying everywhere. Every new application can add more hard inquiries, and too many inquiries make your report look risky. Step 2. Pull all 3 credit reports. You need to know what each bureau is showing, because one bureau may have a collection, another bureau may have a charge-off, another bureau may have late payments or inquiries. Step 3. Remove what should not be there. If collections are inaccurate, duplicated, outdated, or unverifiable, work on getting them removed. If charge-offs are reporting wrong balances, wrong dates, or wrong status, challenge them. If hard inquiries were not authorized, dispute them. If late payments are reporting incorrectly, review them and work on correcting them. Step 4. Lower your credit card balances. Because even if your score is not terrible, high utilization can make you look overextended. And when you already have a big auto loan, the lender does not want to see maxed out cards too. Step 5. Build money down. Because when you are upside down, cash gives you options. Without cash, the dealership controls the deal. With cash, you have leverage. Step 6. Then check your options. Refinance if the rate is high and your credit is stronger. Sell it privately if you can get more than trade in value. Keep driving it if the negative equity is too large. Look at a lease only if the incentives actually help and the numbers make sense. Or downgrade only if it truly lowers the total damage, not just the monthly payment. Because this is the biggest trap. People only look at the payment. They don't look at the loan balance. They don't look at the interest. They don't look at the negative equity. They don't look at the total cost. They just ask, can I afford this monthly? That question keeps people broke. The better question is, what is this vehicle doing to my financial life? Because if the truck payment is eating your savings, hurting your credit, stopping you from buying a house, making it hard to pay bills, and forcing you to roll debt into the next car, then that vehicle is not transportation. It is a financial anchor. So if you are stuck in a high car payment and you are upside down, do not panic, but do not keep digging. First, clean the credit report. Remove inaccurate collections. Remove unverifiable charge-offs. Remove unauthorized hard inquiries. Correct late payments if they are reporting wrong. Pay down credit card balances. Build money down. Then look at refinance, lease incentives, private sale, or keeping the vehicle until the loan catches up. The best way out is not always fast, but it has to be smart. Because once you are buried in a car loan, every option is just a different payment. And the real goal is not to get another approval. The real goal is to stop needing bad approvals.